October is shaping up to be one of those months where almost every data release matters. From jobs to inflation to housing, each report has the power to shift yields, drive sector rotations, and completely change the market tone. Today, I'll walk you through key data points, what they mean, and how market tends to react to them. Stick around because by the end of this video, you'll know exactly what to watch for in the month of October. Now, we kick things off in October, on October 1st, with the ISM Manufacturing PMI data. Now, this is a report that shows how healthy US factories are. It sort of checks the pulse of the economy, and above 50 means it's expanding, the economy is expanding, and below 50 means the economy is contracting. As we can see, since 2023, we've not really breached the 50 mark, which means the economy is essentially in a contraction mode. There are two key components in this report. One is prices paid, which shows if US factories are paying more for material and hints at inflation. And the other is new orders, which shows if customers are ordering more, which hints at future growth. Now, if the PMI data comes in hotter than expected, then that means there is potential upside for the industrial sector and the small caps, which is RUT or Russell 2000 index. If the data is softer than expected, then the yields might slide and small caps might lag on slowdown fears. Next, on October 3rd, we get two events. One is the non-farm payrolls data and the other is the ISM services data. Now, the non-farm payroll data provides us three data points: headline job growth, unemployment rate, and wage inflation. Whereas the ISM services data, which is released on the same day, just a few hours later, is a report on businesses like restaurants, hotels, and banks, basically the services industry, which is most of the US economy. Here's what these reports might imply. If we have a weak jobs data and a slow wage growth, that means markets think the Fed will cut rates, which will help tech stocks like QQQ because lower rates mean cheaper borrowing. Now, if the jobs data is strong and the wages are rising, which means we have a hot economy going on, but the yields will rise, hurting tech because borrowing will become more expensive. Similarly, for the services sector, if we have a strong ISM report and rising prices, then that suggests that we might have high inflation. So yields might stay high, which will again hurt tech. Now, weak ISM report plus cooling prices would signal that there is lower amount of inflation, which can help tech stocks because it can indicate that the Fed might cut rates. Now, after this, on October 8th, we will get the FOMC minutes. These are notes from Federal Reserve's last meeting, showing what they discussed about interest rates and economy. The minutes essentially reveal how divided the Fed committee really is. It doesn't usually move markets like live meetings, but the tone matters for yield direction. If we notice a dovish tone, which is pro towards cutting rates, then the yields would drop, which is great for tech stocks again because borrowing stays cheap. If there is a hawkish tone, which is anti-cutting, then in that case, yields might rise, which pressures all stocks basically, but especially small caps like Russell, as they are sensitive to economic slowdown. Next up, we have the Michigan Consumer Sentiment, which is released on October 10th. Now, this is a survey asking people how confident they feel about the economy and what they expect for inflation in the long term. Now, clearly from the chart, you can see that there is a general downtrend in terms of how the people feel what the consumer sentiment is, and the market is still at an all-time high. Now, usually this sort of data flies under the radar, but it still captures confidence and long-term inflation expectations. Now, what would indicate a bullish scenario here? If we see strong confidence and stable inflation expectations, then that is great for S&P 500 and small caps because it signals a healthy economy. A bearish scenario would be weak confidence and rising inflation expectations, which would mean yields might rise, which hurts tech stocks. Small caps may also struggle if people are pessimistic because it indicates another slowdown or expectation of a slowdown. Next, we have the big one. Now, this is the biggest report of the month, which is the CPI and core CPI day, which will be released on October 15th. Now, the CPI measures inflation for everyday things like groceries and gas prices. And core CPI ignores food and energy for a clearer picture because these tend to be more volatile. This is the biggest report of the month because it shows if inflation is cooling or heating up, which will affect the Fed rate decision. As you can see, I have the CPI and core CPI data charted here, and we see the inflation did rise around the COVID period because of all the Fed stimulus, but then we've seen a steady decline since then. If we have lower than expected CPI, then that signals the Fed might cut rates, lowering yields. Tech stocks will soar and S&P 500 and small caps will often rise too. If there is higher than expected CPI, then that might suggest rates will stay high, pushing yields up. Techs will take the biggest hit, and S&P and Russell might feel the pressure as well. After CPI, we have a double-header day. On October 16th, we'll get PPI and retail sales data. Now, PPI measures what businesses pay for their supplies. Think of it like inflation, but at a business level. And retail sales tracks how much people are spending at stores, because strong spending means a healthy economy, weak spending raises slowdown fears. Now, there are a couple of scenarios here. If we get a soft PPI and weak sales, then that might suggest there is low inflation but weak growth. Tech will do well, but small caps might struggle. If there is hot PPI and strong sales, then that signals sticky inflation and a strong economy. Yields might rise, that will hurt, but banks and cyclicals lift the S&P and Russell index. Now, there is a Goldilocks scenario, which is the best case, which is strong sales and low PPI. Low PPI would mean that there is low inflation at the business level, and strong sales would mean that people are spending a lot of money. This is a perfect balance. Growth without inflation. It will lift everything in the market. Finally, the last data point of the month is the housing market, which will be released on October 17th. This is building permits and housing starts. So reports on building permits, which are plans for new homes, and housing starts, which is actual construction. Housing is a super sensitive sector, and it is super sensitive to interest rates. It affects construction, materials, banks, all of it. Now we can see that the new privately owned housing units has been relatively stable over the last few years. Now, an upside surprise here would mean that housing is holding up despite high rates. Small caps like Russell and S&P sectors like construction and materials will probably rise. A downside surprise in the housing starts or the building permits data might signal trouble in the housing sector, hitting small caps and cyclical industries. With October, it's all about inflation and yields. CPI is the main event, but every report leading up to it shapes our expectations. Now, where do traders usually get caught? Focusing only on headlines while ignoring subcomponents like prices paid in the ISM, wage growth in payrolls, or inflation expectations in the sentiment. These details drive yields, and yields drive markets. Tech will swing with real yields. Small caps are going to react to growth sentiment. If you're positioning yourself to trade in October, then don't just mark the dates. Watch how bond yields also react after each of these reports. Thank you for listening, and I'll see you in the next one.